You're listening to New Retirement Radio, brought to you by the team at Prout Financial Design.
Hello, I'm your host, Certified Financial Planner, Dennis Prout.
I'm Heidi Cartwright, Financial Advisor and RICP.
Advisors associated with Prout Financial Design may be either 1. Registered representatives with and securities offered through LPL Financial, member FINRA SIPC, and investment advisor representatives of Integrated Partners, a registered investment advisor, or 2. Solely investment advisor representatives of Integrated Partners, a registered investment advisor and not affiliated with LPL Financial. Investment advice offered through Integrated Partners, a registered investment advisor. Integrated Partners and Prout Financial Design are separate entities from LPL Financial. Dennis Prout and Nathan Prout are solely investment advisor representatives of Integrated Partners and are not affiliated with LPL Financial. The opinions voiced in this show program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriately qualified professional before making a decision.
WTCM News Talk 580. It's time now for New Retirement Radio with Prout Financial Design of Traverse City, Michigan, with Mr. Dennis Prout and Company. Good morning, sir.
Hey, good morning, Ron. On 2/5, February 5th, there was some question about whether I said the date correctly last week. So I'm just saying it succinctly.
But if you're
Good morning,
listening on
everyone.
Saturday, the
It
rerun.
is 2/7.
Yes, there we go.
Look at, he's a prophet. How did he do that? Well, it's great to be here. Thank you for listening, for all those joining us on this frigid morning, where the Great Lakes stand at about 50% of frozen, or so, given the day. But you mentioned, was it you that mentioned that it's all the way out to Power Island? No?
Yeah, the Bay is considered, West Bay is considered frozen because it's Clinch Park to Power Island, about 6.5 miles.
Is it safe
Ice.
yet? That's what everyone wants to know.
We do not advise.
No one's willing to say.
No.
So don't take your car out. Didn't they, in years back, years ago, didn't they drive their vehicles out there?
Beth says yes.
Isn't there a car in one of the bays that you can go look at? Is it West Bay?
There's a Pinto down there.
Yeah,
somewhere
right.
There's a Volkswagen in Hazara Beach.
Oh, that's right.
Wow.
Oopsie
Well, I guess where all
poopsie.
Pintos should go sometime, right?
Yeah.
Crappiest car known to man after the Yugo, maybe. All right. Well, it's great to be here. If you do have a question of a financial nature, how do they get in touch with us? Please, Ron.
You can text us today or call us either way, and it's just one number. It works both ways. 947-0023, 947-0023, and that is the 231 area code.
Thank you, Ron. And joining us this morning is our own Nathan Prout, Managing Director and Master Elite Advisor with Ed Slott. Good morning, sir.
Good morning. It's great to be here.
Oh, it's great to have you. And then Beth Shire, you probably heard her in the background already, our own Marketing Director. Good morning.
Piping in, yes. Good morning. It's great to be here, and good morning to all of our listeners.
Jon Sluis, CPA with Intrust CPA. It's a pleasure to have you here too, John.
Thank you for inviting me.
Great.
Is that,
And
is
then
that
April
a
15th.
Stormy Cromer hat?
It's a kind of a knockoff Stormy
Okay.
Cromer, but they don't fit me well, so these are not. This is a warmer one, and it fits under the headphones.
Nice. Yes.
So before we jump into planning, Mr. Elon Musk says that you can skip retirement savings in the age of AI, and this gentleman says not so fast. It's like, okay, I guess everyone can say stupid things, and Elon Musk is one of them. Billionaire Elon Musk recently told people not to worry about squirreling money away for retirement because advances in AI or artificial intelligence would supposedly make savings irrelevant in the next 10 to 20 years. And I would say, nay. I think not. I think not. Maybe just a bit. We were talking about it 20 years ago. I was driving through the UP and thinking how long the drive was and how short it would be, short a time frame it would be before we had flying cars. And I was wrong then and still wrong now.
Yeah.
So
You mean you didn't listen to George Orwell?
I didn't. No. So anyway, he may have a point about robots. And this gentleman, Ted Jenkin is his name. Let me translate that into plain financial English. Don't bother preparing for your future because robots and automation will take care of it.
So how? What was their argument? How would you not save for retirement and have robots help you?
Well, it would mean that they would. Oh, here it is. Musk's argument rests on a futuristic idea that AI and robotics will create so much productivity that scarcity disappears. Scarcity disappears. In this world, goods become cheap and cheaper and cheapest. Income becomes universal, and money loses importance.
And communism is.
Communism du jour. It's kind of what they're predicting in essence. And we all know that communism doesn't work. All we have to do is see it in action vis-a-vis Russia, East Germany, Cuba, on and on it goes. Communism does not work. It's a great idea, but put into practice, it stinks. It stinketh.
Yeah, the theory is you could rely on other people. The expenses would be taken care of because it's so the dollars don't matter. So in theory, we shouldn't have any income or any expenses because we should all take care of everybody for everyone else. And we'll see how practical that is. And we know how well that will go.
The only problem is if it's wrong, and or what other opportunities might you be presented with. It just goes on in terms of having that sense of independence. I don't think we need to argue it too much. Yeah. No. It's an interesting concept, and like any other income proposal, it might augment what you're already getting. So anyway, as in Social Security, now when it started, everyone was taxed $1 for every dollar they earned, up to $100, and that was the maximum it would ever be. We all know that changed a whole lot over time. And its ability to fund retirement has never been anything more for most people than a part of retirement. Now, some people do use it exclusively for income, but not that many.
I was sitting with an accountant earlier this week, and he was explaining how easy it is to calculate what your taxes due on Social Security are. It was really straightforward.
Note the sarcasm oozing off of that. So.
Yeah, we were surprised, even. Yeah. So that morphs us or helps us transition into. We were talking a couple of days ago, John, about the 5 areas you would advise people from an accounting standpoint, but it was mixes with financial planning as well. Whenever you're speaking with someone about accounting, and if you would share those 5 things, starting with number 1, what would you view as one of the top areas people should be aware of with tax and their own planning?
Your neighbor might be a nice person, but I don't care about his advice for you.
Okay. So his advice may not be yours. His income may be different than yours. His or her income.
Right. So I'll oftentimes hear people come in and say, my neighbor told me this, or my friend told me this, or I should try this. And many times I say, that's not wrong advice. It could apply. It could be accurate. But does it apply to you? So when we're speaking on the radio here, or when you're reading information, it's general information. It's good tidbits. It's not generally wrong. It's good information. But it may or may not apply to your situation. So what you have to do is take the information and put it through a filter of asking, does it make sense for you? Because just because it worked for your friend or your neighbor or otherwise doesn't mean it makes sense for you.
Actually, as you were talking, I was thinking, well, for some, an IRA makes sense. Well, I want to give it to charity, or all the revenue, the RMDs rather, from my IRA. I want to give to charity. In that case, it may make sense to simply hang on to that IRA for the long term. Next, multi-year planning. What does that mean?
So looking at taxes as a single year event versus as a multi-year item. So I'll preach this pretty regularly. My goal is to pay the least amount of taxes that we're obligated to pay. We certainly don't want to tip the government. We're obligated to pay some, but minimizing taxes should be viewed as an overall lifetime item. So let's pay the least amount of taxes over your lifetime, not over a single given year. So if you look at it as compliance only, or if you look at it in one particular year, you might pay a little bit more one year versus another year because it might save you dollars in the long run. So,
what would you say to someone who absolutely hates paying any tax whatsoever?
I would say that actually when you asked me for 5, I added one more last night to make it 6 because as a good accountant, I can't keep it within 5, right?
Sure.
But I would say to that point is don't aim for no taxes, aim for low taxes. Because if you're not paying any taxes, 1, you're giving up potential deductions, but 2, you're not building your wealth, right? So sure, you get the deductions, you get to take expenses off, but it means that you're not growing your wealth. So what you want to do is, what one should do is aim for low taxes versus no taxes.
That's interesting. How do you mean that they're not gaining wealth if they're not paying any tax? What does that mean?
Well, in order to not pay taxes, your expenses exceeded your income. So, other than the government, who does not have a problem doing that, I would tell most businesses or most individuals that if you're not paying any taxes at all, it's generally because you have greater expenses than you do income, which, okay, some people live that way. It's not wrong per se, but you're not necessarily building your wealth overall because you're spending above what you have in income. So in order to grow your wealth, you have to have greater income than you do expenses. And this is a general topic too, right?
Yeah.
So there are certain circumstances where individuals are going to be okay. You have the right deductions or otherwise. So it's not everybody. And just like we said, number 1, just because we say it for one person doesn't mean it for everybody. But in general, in order to grow wealth, you have to have income greater than expenses. And if that happens, you're going to pay taxes.
This is a beautiful thing.
Again, pay it low, not high. What you don't want to
Right.
do, you want to average over time. And
Yeah, you want to try to manage the averages, if you will, of what it is you're paying in the brackets. And because they're so historically low, paying at the lowest rates can actually be a good thing, filling those brackets up.
Yep. And to
you
expound
might
it
say
further,
as well.
like, so you might say, well, great, I'm going to have no taxes this year. I have special depreciation that allows me to go negative. Wonderful. That's good. You're going to pay no taxes this year, except for when you go to sell that piece of equipment or that building, you're going to take it and going to wallop back and recapture, which means that you're going to pay more in taxes in that year. So wouldn't it be better to have lower taxes for 2 years or 3 years versus no taxes 1 year and really high taxes the next year?
So if you have huge deductions, you might say, well, how can I add to my income this year to maybe
Correct.
offset some
Correct.
of those large deductions
Correct.
in the year in which I take them?
Right. And
So
likewise,
really
if you have
thinking
too
of
much
that.
income in 1 year, then let's take some expenses, right? So
Right.
you're always managing to make sure that you stay steady overall and shoot for low taxes, not no taxes.
Next, minding the gap. What does that mean?
Minding the gap is something that this fits into that topic, which says that, and this is where it's most evident for many people, is you're going through your whole career, you're making, say, $100,000 a year, you're working, and you're deferring income, you're doing otherwise, and then you retire, and all of a sudden you have no income because you're spending your savings, and so your income goes to zero. You go way down because you're spending off of what you've saved. And there's this gap between when you're working and when the IRS says that you are required to start taking your income in, which is the RMD. So there's this period, generally speaking, between 65 and 75. I'm rounding when I say that.
Sure.
But there's that 10-year period where there's a potential where you pay no taxes because you're living off of savings. That gets into it's not necessarily a good thing when you get giddy about the fact that you're not paying any taxes. I would rather manage it and have lower while you're earning, lower during the RMD, and equally even throughout the whole year or the whole period. So mind that gap.
So in essence, saying in those years, perhaps it would make sense for me to do a Roth conversion when I'm 65,
potential.
when my income has gone down,
Yeah.
and I want to fill up perhaps the 10 and the 12% tax brackets.
Yep. or sell some highly appreciated stocks or assets and go contrary to everything that you've been told and preached to, saying don't sell anything, right? So you're looking at maybe recognizing some income in those years.
Would all accountants rather recommend this kind of strategy?
Generally not. No. This is why it's there. But again, this is general information. Don't hear this as saying, well, I heard it on the radio that John said that you could go sell a bunch of tax or investments and recognize income. Because it could hurt you as well. So again, you have to look at your specific situation. This is general advice.
It's great stuff, isn't it, Ron? Isn't it just like really? It's fun. By the way, before we move on,
yes,
that meeting that you helped with, Ron, yesterday afternoon was really fun at the Park Place.
That's our
changing subjects.
Yes.
Sorry, we took it at a 180, but it was really helpful to hear, and there was a surprising number of people there too regarding this Austria,
Switzerland trip.
Yes,
Dennis Prout was there, and about 40 some other people at the Park Place, top floor. So we got to look out at the frozen West Bay, and Gerard from Colette gave a slide presentation. He's done this trip, I think, 6 or 7 times. It's his second most favorite tour, next to Peru.
Okay.
Is that the one through NMC?
No, they've done similar. Well, they work. Colette works with NMC.
Oh, okay.
But they're working with the station here anyway. So we had details, answers last night, telling us what you should wear, how to change your currency, what we'll see on the trip.
Some great questions from the audience
yes.
too.
And Dennis Prout may be going, so won't that be interesting?
Yeah, I'd love to.
People can hit Dennis up on the streets of Austria and say, "Hey, Dennis, I've got a question about my IRA."
Yeah, there you go. Sorry, I don't understand English anymore. By the way, there were a couple of questions.
Oh, yes.
On the text line, please, Ron.
One we have from last week's show, IRMA, which again stands for, what is that again?
Income-related Medicare adjustment. Medicare, AA, whatever the AA is.
So, Medicare adjustments.
Medicare adjustments.
Somebody wanted to know the IRMA penalty charges for income above the threshold levels applies to both spouses on a joint filing. So $1 over the threshold number could cost thousands in extra Medicare premium costs.
It could indeed, and John is going to be discussing
that. Was a fantastic segue into one of the next pieces of advice.
Our Cliff Fest.
Which is mind the cliffs. So this is one cliff, IRMA, that he was referring to. And to answer your question, yes, that cliff, if you're doing a married filing jointly, applies to both filers, both Social Security, regardless if it's one person's income. If you're doing a married filing jointly, it will impact both of the Social Security filings, or particularly it's not Social Security, it's Medicare, which is oftentimes viewed as Social Security because it's a net against Social Security.
Which is a great point in terms of making certain that you understand the details, because we'll talk about things, obviously, here on the radio, and you may think you've misheard or whether we didn't state the full detail. That's where you want to confirm this information with your advisor and or with good information on your own. Yeah. Thank you. Then there was another question.
But before we leave that one, the minding the cliff is one of the pieces of advice, and that's one of those, right? So $1 over that cliff could cost thousands because of additional costs. So in general, we think of taxes as graduated rate. It goes up in theory, but there's not cliffs. There are plenty of cliffs that you have to watch out for. IRMA is not the only one. You've got net investment tax, which is one. So net investment tax kicks in any time you have income over $250,000. So boom, you hit that, and you're going to go over that cliff. Or the senior deduction is one, the SALT deduction's another, ACA premiums, which applies a little bit less now that they've made the changes. But in Social Security taxation is another one. That's where we got talking about the complication of Social Security. So there are cliffs that you have to watch out for. So one more dollar or another $1,000 earned could push things, and that $1,000 maybe ended up costing you $16,000 of income. Or otherwise, you have to really watch those.
Wow. Yeah.
Another question says, Hi. I have a small IRA in local credit union. I would like to put it somewhere. I want to put it somewhere where I can have an auto payment into my IRA. The credit union wants me to go in person to sign something every time I make a deposit. I don't go into town much, therefore my IRA is very little help.
Well, you could always open, to answer the question, you could always open another account at another bank that would offer that if you want to be that conservative with your IRA. Next, if you were okay with some risk, Vanguard would be a great choice for something like that because they can process that on a monthly basis in terms of adding dollars every month. Sometimes they have minimums, $50, $75, $100 per month, but that can be a great way to invest as long as you invest through the investment cycle itself. That's called dollar cost averaging. So through the highs and the lows. But the key to remember is your dollars could be worth less at some point in the future having done that. So really take account of your own risk tolerance. And then if you're not comfortable with that, consider another bank that can do that for you. Okay.
All right, a couple comments on the Elon
Sure.
Musk says in the future you won't have to worry about retirement planning. He says AI will handle it. Somebody said, I think Elon was talking about AI driving down the cost of goods, but you would still need money.
Well, what he
Well,
said,
again,
according to this, was he said not to worry about squirreling money away for retirement because advances in AI will supposedly make savings irrelevant in the next 10 to 20 years. I guess he could have meant several things. I didn't see.
But he might. Let's go with that.
Hang on a second.
Yeah.
I don't know that he really knew if he had gone into any other detail, but that would be that's interesting to note. Nonetheless, that it's probably poor advice. I wouldn't say probably. It is poor advice.
Yeah, it's part of it because it does say later in that article, goods become cheap, income becomes universal, and money loses importance. So
in essence, he was referencing that to a certain degree.
partially.
Yeah.
But in theory, so to add to that,
Sure. Go ahead, John.
that is great theory, right? That theoretically is not wrong. But in theory, the computer was going to make things much more efficient, or others. The internet was going to do things, right? Or if you go back to the 1960s or the 1600s, the next generations, whatever it is going to make society better and irrelevant or otherwise. But it has historically proved that it's not the case. So in theory, it sounds wonderful, but it's great right there in theory.
Yes. It's a theory only.
And just one more comment on the same topic there, Elon. It says, so that guy with the $852 billion net worth is telling people with net worth under $100,000 that they don't need to save and invest.
Yeah. And what did he just, he's merging SpaceX with one of his other companies and creating a behemoth of wealth. So I would say if you can create wealth on your own, it's probably a good idea.
Yeah,
Right.
he is on track to be like the world's first trillionaire. Well, on record anyway.
Yeah.
They said when he moved Twitter X out of California to Texas, then they moved SpaceX's in Texas, that his theme song should be "All My Exes Live in Texas."
It'd be perfect for him. I don't know whether he's glommed onto that yet, but that'd be great. Hey, John, let's hit the other points. Point number 4. Now, we already talked about minding the cliffs. So those are key pieces of information. So it's the cliff that can really impact your total tax. It's $1 difference there.
For the cliffs, yes.
So that's a great question to ask either your CPA and or to ask your software. What are those cliffs that I need to be concerned about, perhaps?
And oftentimes, it's too late by the time you're doing the software or otherwise because you've already exceeded or gone over the cliff. So knowing that ahead of time of what can I do, well, how much should I do? So knowing that those brackets. And again, one person's cliff might be different than another person's cliff, because if I'm talking to someone in Social Security, it's in one income bracket versus someone that's talking the cliff for net investment tax, which is $250,000. Different cliffs. So different people are gonna have whatever cliff is in their realm of what they're looking for.
All right. And then you also mentioned tax simplification, that it's not really ever happened.
They came close in 2018 under that one, made it simpler. This new tax law in 2025, the OBBBA, the One Big Beautiful Bill Act, which we're still trying to find the beautiful part of it, certainly went the other direction, and it made things much more complicated. So the theory of simplification went out, because ultimately you're going to find that attorneys and accountants are going to do their best to work their way around anything anyway.
Sure.
But a great example of this is not accountants or attorneys. This is under the new simplification in 2018. they increased the standard deduction, which made it so more and more people didn't have to worry about receipts and itemizing and all that stuff. Well, because of that, they stopped donating dollars to charities because it didn't do any good from a tax deduction. So why do it, in theory? So then the charities, they lobbied and said, hey, wait a second here. That tax law hurt us and impacted us. We want it back. Well, great. Under the new tax law, there's an additional deduction for charitable contributions, cash contributions. This is started in 2026. It's not an itemized deduction. It's now another deduction. Mm-hmm. So does it apply? Does it not apply? It has caused more complication in it because they're trying to have their cake and eat it too, right? They want to keep the high standard deduction, but they want to appease the charitable organizations that were being hurt. And it's in a world where you're trying to appease everybody, simplification never ends up good.
Yeah. That's a good point. And then you said point number 5, big events and planning in advance, trying to include those together as being critical.
Yeah. So I call this one, let's address the elephant in the room, which is you and I talk a lot on saving, doing different things, Roth conversions, doing the saving for retirement through even traditional, or finding that tax deduction for buying that piece of equipment, whatever it is, which is all good things, but it has pretty small tax impact overall. At compounding, it could. But what most people don't recognize or see is the singular event that oftentimes has the most tax impact. Selling your business, transferring your wealth, doing various different things that are more the one-time items have significant tax impact. Big, huge dollars. And oftentimes people are afraid to address those because it comes with having to deal with something that they don't want to. Means I don't want to sell my business. I don't want to retire. That means that I'm old. I'm not ready to do that. I don't want to think about it. So therefore I'm going to stick my head in the sand and not address it. It might mean transitions in family, but that means I'm going to have to talk to my 2 siblings that I don't want to talk to. Or it means that I'm going to have to determine how do I give this to my kids, and that means I'm going to have to think about treating people differently or otherwise. So it's oftentimes dealing with that elephant in the room that is a complicated topic is some of the best tax advice I can give, because people would prefer to not deal with that big issue and just pay more in taxes when it comes.
So how would they approach some of these issues first, just looking at the basics? Let's say we've got somebody who's looking at selling a business. They may be 3 to 5 years out. What sort of planning and or advance conversations might they have?
Well, the first thing is, you implied it even within the question, is you said advance. So
Right.
That's the first one, is you're thinking about it ahead of time. You're looking, if you're thinking of selling your business, or you're thinking of doing a transfer for families or others, don't do it the year of. Do it plenty of years before.
Do the planning.
Do the planning, 5 years, 10 years, 15 years. That's one. Another one I would say is write it down. So say, okay, my goal is this, and then put a goal to it. Write what you're going to do, and then follow through on that. So break up. So going back to the title, is addressing the elephant in the room. How do you eat an elephant in the room? One bite at a time. And so you take it up in little pieces and saying, okay, well, I'm not going to deal with everything all at once, but this year I'm going to deal with this. Next year I'm going to deal with that. The following year we're going to work on this. So taking it one bite at a time. The other one is relying on advisors, relying on people around you to help with that, right? I oftentimes tell my clients, I have really thick skin. Blame me. So if you need to confront someone, you need to deal with that manager you're gonna have to deal with as part of a sale, but you don't want to do it. Blame me and say, my accountant is making me do this. If you need to deal with your kids, say, my accountant's telling me I need to do this, and that's okay. So
having the difficult conversations, but maybe with you first, in terms of what I'm thinking is consult with your advisors first about what it is you're thinking, or at least try to put it into words, and begin the conversation about potentially what we might be looking at.
Practice the discussion with advisors or with other people.
I love that, because then you're able to allow your brain to process what it is you're thinking. And you may say things as a seller, let's say, of your business, that in the end, after 24 hours, you go, oh, I guess I really didn't mean that, or that doesn't make sense. So it allows your brain, if you will, to begin to process what it is I'd really like to achieve with that change, and what it could mean then to others. So it might then allow you to have some conversations with those that follow.
Mm-hmm. Yeah.
And they may have some different views on things that surprise you as well. Do you see that very often, when you've got more than one individual selling a business, John?
Very regularly. We do this on a...
I thought I'd ask a gimme question, of course.
That's fair. I frequently say, you tell your pastor most things and your accountant everything else. Right, and so we
wow,
yeah, yeah, we deal with that on a regular basis because it's the things that people don't want to address. But money doesn't, and taxes don't lie; they're there. You see them, and so in order to deal with that, you have to deal with the familial, with the social or economical items that come with it.
So there are certain ways to begin to process this. Start perhaps with baby steps in terms of beginning to have conversations with your trusted advisors about these things.
Right, because the first conversation you have to have is with themselves, oftentimes, right? So you're jumping even ahead to saying, okay, we're going to talk to the manager or the family or others, but it's even internally talking with yourself because it's saying, okay, am I ready to retire, or do I really want to sell this, or what am I going to be working through? Those are some of the issues that people don't want to deal with. So.
What do we got for stats?
Yeah. So according to Reuters, BlackRock's assets crossed the $14 trillion mark after the fourth quarter profits beat initial estimates. As a result, the quarterly dividend increased by 10% and the share buyback authorization rose by 4%.
Boy, what a meteor is BlackRock. So much under management. That is huge. 14 trillion with a T.
Yes. Yeah. And between November and December of last year, President Trump purchased nearly $100 million in municipal and corporate bonds, including $2 million in Netflix and Warner Brothers Discovery bonds post-merger. In addition to local school districts, city bonds, utilities, and hospitals, President Trump also purchased Boeing, Occidental Petroleum, and General Motors.
He wanted tax-advantaged income, imagine.
Yeah, and then we have a little announcement. Prout Financial Design is going to be sponsoring concerts with the TC Phil next February.
Nice.
Or this February, 14th and 15th. They're both the same concert. It's called the Side by Side concert, and it is at the TC Phil Center. So February 14th, it's at 7:30, and the 15th, which is Sunday, it will be at 3 o'clock. And those are they're going to have two pianos there, two pianists, and they're going to be playing some, let's see, what does it say? American classics composers. So that'll be great. Either concert, you can purchase tickets on the TC Phil website, and it's going to be a great time.
Cool.
Thank you, Dennis Prout.
Hey,
for
pleasure.
sponsoring. Yeah,
you bet. Yeah.
I have a question. You want to tackle a question?
Sure.
We have on the text line. I have a 401k. I can borrow up to $50,000 with a $75 origination fee, and pay back direct to myself monthly at 8% APR. I'm in a low-risk portfolio at close to 7%. What may be the tax implications if I borrow against the 401k to purchase a big-ticket item I use in my side business as opposed to going to the bank? Historically, any loan taken by the side business has been paid off well before the maturity date.
John, why don't you hit that? What do you say, John, to the tax implications and otherwise?
I will speak only to the tax implication of this.
All right.
And the tax implications are you are taking, yes, you are paying yourself, so in theory, left hand, right hand, but you are taking after-tax dollars to put them back into your retirement account, which you're going to then turn around and pull back out. That's at a taxable. And so, yes, while you are paying yourself left hand, right hand, you're going to pay tax on yourself.
Okay, why are you calling that after-tax dollars?
Because you're taking the interest that you're paying in, you've paid taxes on it. So you earned $100 from working, paid taxes on that $100, and now you have some cash left over. And you're going to use that to pay the interest on your own loan. So you're using after tax. You've paid taxes on it already. So you paid once on it. You're going to put it back into your 401k as earnings of the 401k, and then when you pull it back out, you're going to pay taxes again.
Yeah.
I don't like taxes. I hate double taxes.
So that's a double taxation from your standpoint. Even though they're pulling out before tax money, it's a deductible 401k that they deducted it when it went in.
The loan
lump sum comes out tax-free to purchase that asset. But what you're saying, their payments then are being paid with after-tax money because you had to pay tax on that income in order to put it back into the 401k.
Yep, and then it comes back again when you get it. So yes, the 401k is earning, but it's earning up against you. So yes, when you pull it out as the loan, it's tax-free at the loan, but it has to go back in there. The mechanisms of them, it must get paid back or recognized as income, including the interest. So ultimately, you're going to double pay taxes on that. So
and how's that compared to the bank? They said if you just go to the bank for a loan, tax-wise.
Well, then you're not going to. So if you borrow you're going to pay. You pay it once. Then you're using after-tax dollars to pay it once because you're not going to take that income back.
It depends on whether or not you could deduct it as a business expense as well, which most likely you could. But the other part of it is that money, in essence, is not growing within your 401k. It's going to depend on the rate that it could grow at. But that lump sum is not in there. Yes, I see that hand over there, Nathan.
Yeah, so just obviously some assumptions there, too. It says, typically you earn 7%, I think, if I'm reading that correctly. So if you take $50,000 and take the full 5 years to pay it back, let's say it was $80,000 before you took that loan. At a 7% interest rate over 5 years, that grows to $112,000 approximately, or about $32,000 in growth over that 5-year period. But if you take that loan and it decreases to $30,000, that $30,000, of course, only grows to $42,000-ish. So only about $12,000 of appreciation. So you missed out on the potential appreciation. Now, obviously, you have the payments going back into that, so the difference will be a little less drastic, but you're still missing out on that compound interest opportunity, which the larger the balance, the more compound interest, right?
Yeah. In essence, you're most likely going backwards when you do that kind of a transaction, to borrow money out of your own 401k.
Right. And there's no tax implications, assuming you follow the payback. But if you don't, and you are under age 59 and a half, that whole transaction does become taxable, and you have a 10% penalty that you have to pay. So, John was talking about just double taxes as your best case scenario. The worst case scenario can go even further than that. So.
One other thought from another texter on that, too. If you borrowed the money from your own 401k, this person says, I think also if you do leave that job where you have your 401k, the money that you borrowed has to be paid back immediately, doesn't it?
Right. They give you the option to pay it back immediately, and if you don't, then that's income. Where that becomes income and taxable and penalized and all those sorts of things if you're under 59 and a half. And it's IRA money.
So the truck that's coming down the road could be heading for you in that sort of a transaction. Thank you very much. All right. Yeah, those are great questions. All right, John, we've got, how much time here, Ron? About 4 minutes.
You gave me 4 minutes to talk about the OBBA.
Yeah, break it down for us in 4 minutes, John.
I could probably take it over like 6 or 7 of these whole radio shows, and you gave me 4 minutes.
Just talk about the O.
The O, yeah. I'll focus on the B, the beautiful part.
The new senior deduction is the big one.
Senior deduction, I'd say the senior deduction and then the tips and overtime. So I'm going to hit the tips and overtime for everyone there. Because of the shutdown, they did not change the W-2 reporting. They couldn't make it done fast enough, and so it may not be given to you the information and what you're going to need. But tips and overtime potentially could be not paying income tax on it, but you need to know that number. Some of the times it's on the W-2, not always. So make sure you're aware of that.
All right. Next, the senior deduction.
Senior deduction, which is meant to. They attempted to make Social Security tax-free, concluded that was a very complicated thing to do, and they couldn't do it, so therefore they gave a senior deduction that you should be aware of. Anyone that is a senior so age 65 and older, will qualify for that. It does phase out, so you have to watch out for that. But they're giving you $6,000 per person, again, subject to phase out or otherwise, that you can take as a other deduction. You don't need to be taking Social Security. Interesting enough, has nothing to do with Social Security, but it does interplay inside of it. So.
What would you say about the standard deduction? It says continues and adjusts the higher standard deduction. So
So the biggest impact of the OBBA is that it made the tax extension or the tax savings that went into place under the TCJA in 2018,
Tax Cuts and Jobs Act. Yeah.
It made that permanent. So what they did is that Tax Jobs Cuts Act lowered the rates and increased the standard deduction, but they did it for a 10-year period, and then it was going to sunset at the end of 2025. The OBBA made that permanent, and I'm putting it in air quotes permanent because the government can always change things. But as of right now, it's not set to sunset like it would have otherwise. So the biggest impact of the OBBA was that it made those things that had already happened and continued those on. So we won't necessarily feel them. You would have felt the absence of them. Everyone's taxes would have gone significantly up because the tax rates would have gone down, or tax rates would have gone up and the standard deduction would have gone down, so you would have actually had increase in taxes.
Now, what is the standard deduction right now for a couple?
Yep. I'm not going to answer that actually, because I would say it got more complicated because it depends on whether or not you're single, you're married, whether or not you're over senior or under, or if you're a senior or not. So it changes for many people's particular situations. So yes, you can find it, but that gets into the tax law has become more complicated because I can't just give a straight answer anymore.
I just asked a simple question, John.
Yeah,
oh my
I know,
gosh,
right?
really?
Yeah. I joke. I long for that chance that I can answer a question with a yes or no.
Try this
After
one.
doing this over 20 years, I have not been able to have it happen yet.
Text
Yes.
question. My total income, $17,000. Do I need to file taxes?
Maybe.
Yes or no?
It depends on the nature of what it is. So that I cannot say yes or no because it depends on if it's unearned income, earned income, depends on if it's self-employment income, depends on if it's dividends. So maybe there's a chance that you wouldn't have to, but I can't answer without knowing
If
more
it's
details.
hypothetically just Social Security on that 17,000.
Then no.
Okay.
Wow.
Well, if it's just Social
If it's
Security income,
solely Social Security income, so Social Security in and of itself is not taxable, but it is used in its own calculation to determine whether it is taxable.
So you don't even have to file a return in that case.
If all you have is your Social Security check, then a tax return is not needed. If that is your only single source of funds coming in.
Okay.
That's tax simplification.
There you go.
You betcha. All right.
alrighty.
We're good. Thanks, Ron.
That'll wrap up another episode of New Retirement Radio with Prout Financial Design, Dennis Prout and Nathan Prout in Beth Shire. Thanks for being in today.
Pleasure.
And Mr. Jon Sluis from Intrust CPA, Traverse City, Michigan, special guest.
Thank you.